Today we're diving into the world of break-even analysis, a fundamental tool for anyone in business or finance. Whether you're launching a new product, running a small business, or just curious about how companies determine when they start making a profit, understanding break-even analysis is essential. In this video, we'll break down the basics, walk through key concepts, and show you how to apply break-even analysis in real-world scenarios. Let's get started by exploring what break-even analysis actually means and why it's so important for decision-making. Break-even point is where total revenues equal total costs, meaning you're not making a profit, but you're not losing money either. This point is crucial because it tells you the minimum amount you need to sell to cover your expenses. If you sell less, you operate at a loss. If you sell more, you start making a profit. Understanding this concept helps businesses set realistic sales targets and pricing strategies. Next, let's look at the components that go into calculating the break-even point. Costs are expenses that remain constant regardless of how much you produce or sell. Think of things like rent, salaries, or insurance. These costs don't change even if your sales go up or down. Fixed costs are a key part of break-even analysis because they set the baseline you need to cover before you can start thinking about profits. In the next scene, we'll talk about variable costs and how they differ from fixed costs. Variable costs, on the other hand, change depending on how much you produce or sell. These include things like raw materials, direct labor, and shipping costs. The more you sell, the higher your variable costs. Understanding variable costs is essential because they directly impact your break-even point. When combined with fixed costs, they give you a complete picture of your total expenses. Up next, let's see how to bring these costs together in the break-even formula. Now let's put it all together. The break-even point is calculated using a simple formula: fixed costs divided by sales price per unit minus variable cost per unit. This tells you exactly how many units you need to sell to cover all your costs. It's a straightforward calculation but incredibly powerful for planning and decision-making. In the next scene, we'll walk through a practical example to see how this formula works in action. Imagine you run a small bakery. Your fixed costs are $2,000 per month. Your variable cost per loaf is $1 and you sell each loaf for $3. Plugging these numbers into the formula, $2,000 divided by $3 minus $1 equals 1,000 loaves. That means you need to sell 1,000 loaves each month just to break even. Any sales beyond that point contribute to your profit. Let's explore what happens if your costs or prices change. But if you decide to increase the price of your loaves to $4, now your break-even point drops to 667 loaves. By raising your price, you need to sell fewer units to cover your costs. However, higher prices might reduce demand, so it's important to balance pricing with customer expectations. Next, let's see what happens if your variable costs go up instead. Suppose the cost of ingredients rises and your variable cost per loaf jumps to $2. With the original $3 selling price, your break-even point increases to 2,000 loaves. This shows how sensitive your break-even point is to changes in costs. Keeping an eye on both fixed and variable costs is crucial for maintaining profitability. Up next, let's discuss the concept of contribution margin. Contribution margin is the difference between your sales price per unit and your variable cost per unit. It tells you how much money from each sale goes toward covering fixed costs and eventually profit. A higher contribution margin means you reach break-even faster. This metric is vital for analyzing profitability and making informed business decisions. Now, let's see how break-even analysis helps with planning. Break-even analysis isn't just about finding a number, it's a powerful planning tool. Businesses use it to set sales targets, evaluate new projects, and make pricing decisions. By knowing your break-even point, you can forecast how changes in costs, prices, or sales volume will impact your bottom line. This proactive approach helps you avoid surprises and make smarter choices. Next, let's look at how break-even analysis supports decision-making. When faced with tough decisions, like launching a new product or entering a new market, break-even analysis provides clarity. It helps you assess risks, estimate required sales, and determine if an idea is financially viable. By understanding your break-even point, you can weigh the pros and cons before committing resources. In the next scene, we'll see how break-even analysis is used in real-world business scenarios. Break-even analysis is used across industries, from retail to manufacturing to services. For example, a restaurant might use it to decide whether to add a new menu item, while a tech startup might use it to evaluate a new app feature. By applying break-even analysis, businesses can make data-driven decisions that improve their chances of success. Next, let's discuss some limitations of break-even analysis. A break-even analysis is a valuable tool. It does have limitations. It assumes that costs and prices remain constant, which isn't always true in the real world. It also doesn't account for changes in demand or external factors like competition. Understanding these limitations helps you use break-even analysis wisely and combine it with other tools for better results. Up next, let's explore how to visualize break-even analysis. Break-even chart is a simple way to visualize the relationship between costs, revenue, and profit. On the chart, the break-even point is where the total cost and total revenue lines intersect. This visual representation makes it easy to see how changes in price or costs affect your break-even point. In the next scene, we'll walk through creating a basic break-even chart. Create a break-even chart. Start by plotting your fixed costs as a horizontal line. Next, add your total cost line, which starts at the fixed cost level and rises with each unit sold. Then plot your total revenue line, which starts at 0 and increases with sales. The point where the total revenue and total cost lines cross is your break-even point. This chart helps you quickly assess your financial position. Now let's discuss how to use break-even analysis for goal setting. Break-even analysis is a great tool for setting realistic sales goals. By knowing exactly how much you need to sell to cover your costs, you can set targets that are both ambitious and achievable. This approach helps motivate your team and keeps everyone focused on what matters most, reaching profitability. Next, let's look at how break-even analysis can guide pricing strategies. Break-even analysis helps you evaluate different pricing strategies. By adjusting your sales price, you can see how it affects your break-even point and overall profitability. This insight allows you to test various scenarios and choose the best pricing approach for your business. In the next scene, we'll discuss how break-even analysis supports cost control. Monitoring your costs is essential for staying profitable. Break-even analysis highlights the impact of both fixed and variable costs on your bottom line. By regularly reviewing your costs and looking for ways to reduce them, you can lower your break-even point and increase your profit potential. Up next, let's see how break-even analysis fits into overall business planning. Break-even analysis is a key part of business planning. It helps you forecast cash flow, set budgets, and prepare for growth. By understanding your break-even point, you can make informed decisions about investments, hiring, and expansion. This strategic approach sets your business up for long-term success. Next, let's talk about using break-even analysis for risk management. Every business faces risks, from changing market conditions to unexpected expenses. Break-even analysis helps you identify potential risks early by showing how changes in costs or sales volume affect your profitability. This allows you to prepare contingency plans and respond quickly to challenges. In the next scene, we'll explore how break-even analysis supports investment decisions. In considering new investments, like equipment, marketing, or product development, break-even analysis helps you evaluate the potential return. By calculating how many units you need to sell to cover the investment, you can decide if it's worth pursuing. This approach ensures your resources are used wisely and supports sustainable growth. Next, let's look at how break-even analysis can be used for performance measurement. Break-even analysis isn't just for planning, it's also a valuable tool for measuring performance. By tracking your actual sales against your break-even point, you can quickly see if you're on track to meet your goals. This ongoing monitoring helps you make adjustments and stay focused on profitability. In the next scene, we'll discuss how break-even analysis can be adapted for different business models. Different businesses have different cost structures, so break-even analysis must be adapted accordingly. For example, service businesses may have lower variable costs but higher fixed costs, while manufacturers face the opposite. Understanding your unique cost structure ensures your break-even analysis is accurate and useful. Next, let's explore how technology can simplify break-even analysis. Today, many software tools can automate break-even analysis, making it faster and more accurate. These tools allow you to input your costs and prices, then instantly see your break-even point and test different scenarios. Leveraging technology saves time and reduces errors, so you can focus on making strategic decisions. In the next scene, we'll discuss the importance of regularly updating your break-even analysis. Business conditions change, so it's important to update your break-even analysis regularly. Changes in costs, prices, or sales volume can all impact your break-even point. By keeping your analysis current, you ensure your decisions are based on the latest information. This proactive approach helps you stay competitive and profitable. Next, let's look at some common mistakes to avoid. Some common mistakes in break-even analysis include underestimating costs, overestimating sales, or ignoring changes in the market. These errors can lead to poor decisions and financial losses. To avoid them, always use accurate data, review your assumptions, and update your analysis as needed. In the next scene, we'll discuss how to communicate break-even results to your team. Sharing break-even analysis results with your team helps everyone understand the financial goals and challenges. Use clear visuals like charts and graphs to make the information easy to grasp. Open communication ensures everyone is aligned and working toward the same objectives. Up next, let's see how break-even analysis can support negotiations with partners or investors. Break-even analysis is a powerful tool in negotiations with partners, suppliers, or investors. By demonstrating your understanding of costs and profitability, you build credibility and confidence. This transparency can lead to better deals and stronger relationships. In the next scene, we'll discuss how break-even analysis can be used for personal finance decisions. Break-even analysis isn't just for businesses, it can also help with personal finance decisions. For example, if you're considering a side hustle or investment, break-even analysis shows how much you need to earn to cover your costs. This approach helps you make informed choices and avoid financial pitfalls. Next, let's summarize the key takeaways from today's video. Wrap up: break-even analysis is a versatile tool that helps you understand costs, set goals, and make better decisions. Whether you're running a business or managing your personal finances, knowing your break-even point gives you a clear path to profitability. Remember to update your analysis regularly, use accurate data, and communicate your findings clearly. Thanks for joining us on this journey to mastering break-even analysis.